The U.S. economy is doing so well. That's simply the answer. We're in sort of the pre-earnings kabuki dance, if you will, right before we start the whole earnings cycle again. But I expect we're going to see very strong numbers. I think we're going to see very, very strong numbers from the banks. And bank valuations are extremely low right now. The stocks have not done well more recently. But valuation support is tremendous, and ultimately it's earnings growth that's going to drive these stocks higher.
Last week in the Fed minutes, they did begin to express some worries about what could happen to the broader economy because of what's going on with trade. But as Dom pointed out, so far, pretty resilient. We looked at the jobs reports, and that was good, and sort of just that kind of absorbed any worries that we had from the tariffs going into place with China, the $34 billion. So at what point, if the Fed's worried about it now, at what point do we start to worry where corporate earnings aren't enough and the economic story starts to fall apart?
I think you'd have to see it ratchet much, much higher and even beyond tariffs. It would have to go beyond, because again, the trade disparity between the U.S. and China is what it is, and it's what the administration is going after right now. If it spilled out beyond that, which I don't think it will, but on the other hand, it's going to take some time for these things to be resolved. They're complicated matters. They took many decades to build, and you're not going to resolve them in 3 or 6 or 12 months. You know, it's going to take some time.
So where's the opportunity right now? Because we've talked about this idea that small and mid caps might be the place to be because they're more U.S. focused. It feels for many like they've missed the train on the small cap side of things. They've already grotesquely outperformed the S&P.
Right.
Are there other opportunities in the market right now besides small caps, or is that the place you should be?
Well, again, you know, we still have a rising interest rate environment. And as I've said before, the only bond asset class that you can actually do well in a rising rate environment are convertible securities. And that's another asset class that I think it's very easy for investors to overlook. And convertibles have done very well. They're actually outpacing the S&P this year as well. Not quite as good as the Russell 2000. But you have that similar opportunity set where the underlying strength of those companies, the underlying earnings growth, because most of the index is healthcare and technology, is extremely sound. And again, still has a little bit more of a domestic focus to it, similar to the Russell in that regard.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.